A 77% crash does not begin with panic. It begins with arithmetic. Most people think danger arrives with sirens, headlines, and red screens. That is not how the stock market really punishes you. The punishment starts much earlier, when price floats too far above earnings, when optimism gets mistaken for value, and when a whole generation is taught that gravity has been repealed because the line on the chart has gone up for a while. I have spent my life allocating capital, and one lesson comes back again and again. Markets do not stay suspended in the air just because people want them to. They rise, they drift, they levitate, and then, at some point, gravity returns. The only question is whether you prepared for gravity while everyone else was celebrating altitude. That is the part ordinary investors hate to hear. They want reassurance, they want a slogan, they want someone to say the market always goes up. Just keep buying, just keep holding, just keep averaging in. And time will heal everything. They want a religion they can outsource their fear to. What they do not want is the ugly truth that real returns can go nowhere for a decade, sometimes two, sometimes longer. If you begin at the wrong altitude, I do not care what your brokerage app says in nominal terms. I care about purchasing power. I care about what your money can buy after inflation has taken its cut. I care about what remains after the market stops flattering you. If you bought American equities at certain peaks in history and measured the result, honestly, not cosmetically, you could wait an astonishing length of time and still feel like you had been standing still. There were stretches when a patient, obedient, buy-and-hold investor could spend years, then decades, learning that patience without valuation discipline is not wisdom. It is just prolonged exposure to gravity that offends people because the modern savings industry has sold them a simpler fairy tale. The fairy tale says earnings go up, so prices go up. The fairy tale says broad index ownership is automatically safety. The fairy tale says consistency matters more than entry price. The fairy tale says the market rewards faith. I have never trusted fairy tales with my money. Price is not driven by earnings alone. Price is earnings multiplied by the multiple people are willing to pay for those earnings. That second piece is where the air lives. That is where hope lives. That is where fashion, passivity, liquidity, demographics, and narrative live. Earnings are the business. The multiple is the crowd. And when the crowd gets euphoric, the multiple can do far more work than the business itself. That is why gravity matters. A business can improve modestly while its stock explodes because people keep paying a richer and richer multiple. Then the business can continue improving and the stock can still go nowhere or go down hard. Because the multiple starts compressing, the public sees earnings and thinks engine. I see the multiple and think altitude. Altitude is wonderful until it meets gravity. That is the mistake hidden inside most retirement advice. It tells workers to look at ownership as if ownership were one smooth escalator. It is not. Ownership at the right price is powerful. Ownership at the wrong price can leave you trapped in an elevator cable that suddenly decides to remember physics. I have watched this happen across cycles. Investors later act shocked. But the real shock is that they were taught to ignore the mechanism. They were taught to look at corporate profits and never ask what multiple had already been baked into the price. They were taught to celebrate rising account balances without asking whether those balances were being built on business performance or on a crowd willing to suspend gravity a little longer. When you study long market history, honestly, you stop speaking in slogans. You start speaking in ranges, probabilities, and mechanisms. You begin to see long valleys where inflation, adjusted returns were weak or miserable, not because capitalism died, but because price had gotten ahead of reality and gravity spent years correcting the error. That is the part almost nobody wants to internalize. They think danger is a bad earnings report. They think danger is a recession headline. They think danger is a geopolitical scare. Those things can trigger the move. Yes, but the real vulnerability was usually created before the trigger ever arrived. The vulnerability was created when investors decided valuation no longer mattered. Because flows were strong, optimism was cheap, and passive buying felt as reliable as the sunrise. What really humbles a market is often not collapsing earnings. It is collapsing willingness to pay absurd prices for ordinary earnings. That is gravity in financial form. You can map this in rough scenarios. If the market only falls back toward a more recent historical average multiple, the damage can still be severe. A decline that looks like a nasty correction to television anchors can be a life-altering event to a household that needed those assets for retirement timing. If valuation drifts back toward a broader long-term norm, the drawdown can become far uglier. If fear takes the multiple down to the kinds of troughs that emerge in true secular bear markets, you stop talking about pain in polite percentages and start talking about devastation. That is how you get numbers that sound absurd to casual investors and sound perfectly plausible to anyone who understands gravity. A one-third decline is not absurd if altitude is excessive. A halving is not absurd if the crowd has spent years paying too much. A collapse in the 70% range is not absurd in a genuine washout where both optimism and liquidity get vacuumed out at the same time. I am not telling you the exact percentage because precision is where fools like to hide. I am telling you the mechanism because mechanism is what survives the next headline. Now we come to the second lie ordinary investors believe. They think the market rises because investors wake up each morning, thoughtfully analyze businesses, and then price them with sober rationality. That happens at the margin. But there is another force that matters tremendously in a passive age. Money flows. If millions of workers are automatically sending part of every paycheck into broad index funds, and fewer people are withdrawing from those same vehicles, prices receive steady lift. Lift feels like truth when it lasts long enough. People confuse constant inflows with proof that prices were always deserved. They see the line go up and conclude the market has spoken. Sometimes the market has simply been fed. A machine that is constantly fed can look brilliant even when it is merely being fueled. For years, a great many investors have benefited from a system where fresh labor income kept being converted into automatic financial demand. The worker did not need to think. The planned contribution happened. The index fund bought. The demand arrived on schedule. That is a powerful support mechanism. It can keep valuation rich far longer than skeptics expect. It can make gravity look weak, but gravity does not disappear. It waits. What happens when the flow picture changes? What happens when the society that spent decades feeding the machine begins to retire and pull money out instead of shoving money in? What happens when the number of people drawing from financial assets rises faster than the number of people contributing to them? What happens when labor markets soften, jobs disappear, or wage pressure weakens, and the monthly river that kept feeding passive vehicles is no longer so strong? Now you begin to see why I care less about slogans and more about structure. A market that rose with the help of persistent inflows can fall when those inflows stall, reverse, or simply fail to overpower withdrawals. That is not ideology. That is plumbing. Most investors spend their time arguing about narratives while the pipes underneath them determine whether the floor will hold. This is why demographics matter. This is why labor market deterioration matters. This is why automation and efficiency trends matter. This is why retirement waves matter. Because when a market becomes accustomed to lift, even a reduction in lift can feel like a crash. And if reduced lift arrives at the same time valuation is high, the descent can become far more violent than the average household is emotionally prepared to handle. The most dangerous moment in finance is not when everyone is terrified. It is when everyone is calm inside a fragile structure. I want you to think about the ordinary saver. He believes he is conservative because he owns a broad index fund. He believes he is diversified because the fund owns hundreds of companies. He believes he is disciplined because he never sells. He believes he is safe because financial culture told him that participation is prudence. But what if the price he paid already embedded years of optimism? What if his real risk was not stock picking, but crowd pricing? What if he outsourced his judgment to a formula that assumes time automatically neutralizes valuation? Then he is not conservative. He is exposed. I do not say that to insult him. I say it because clarity is kinder than false comfort. The market does not reward people for reciting slogans. It rewards them for understanding what they own, what they paid, what can force them to sell, and what mechanism is currently supporting the price. That last part matters enormously. Ask yourself, what is carrying prices? Is it extraordinary growth in underlying earnings, or is it the crowd paying richer multiples? Is it true value creation, or is it passive demand, liquidity, and the habit of automatic buying? Those are not the same thing. The crowd hates this distinction because it threatens the easiest version of investing. It forces people to admit that valuation still exists. It forces them to admit that long periods of disappointment are possible. It forces them to admit that a passive strategy can be a very intelligent tool at one valuation and a very lazy trap at another. I have never objected to simplicity. I object to mindlessness. There is a difference between owning a fine business for a long time and blindly handing money to the market at whatever altitude the crowd demands. One is investing, the other is surrender. The psychological damage from getting this wrong is larger than most people realize. When investors are told that time will cure everything, they begin to build life plans around that belief. They assume retirement dates, they assume tuition funding, they assume the house move, they assume the second act of life will begin on schedule. Then gravity arrives, and they discover they were not owning a timetable, they were owning a hope. Hope is not a reserve asset. This is why I keep returning to cash and short. Term treasury bills when other people call it old-fashioned. Dry powder is not cowardice. Liquidity is not laziness. Optionality is not indecision. In an overpriced environment, cash is not dead weight. It is uncommitted intelligence. People love to sneer at cash during the levitation phase. They call it missing out. They call it being left behind. They call it unproductive. That is because they only measure return during the ascent. They never measure the value of not being trapped when gravity returns. If you keep a meaningful reserve in instruments that preserve liquidity and limit duration risk, you are buying something many investors do not appreciate until it is too late. You are buying freedom from forced action. Freedom matters. If markets fall hard and you are fully deployed, highly emotional, and dependent on next year, as asset value, gravity owns you. If markets fall hard and you have liquidity, patience, and no forced selling pressure, gravity may wound you, but it does not control you. That difference is enormous. I am not telling you to hide from every asset. I am telling you to stop worshiping exposure for its own sake. There are times when being fully invested is rational, and there are times when it is vanity disguised as courage. The public confuses constant action with intelligence. I have made a career out of doing the opposite. Sometimes the highest return decision is refusal. Refusal to buy at absurd valuations, refusal to accept weak prospective returns just because the crowd is euphoric, refusal to turn retirement savings into a hostage of multiple expansion, refusal to pretend liquidity has no value. That kind of refusal power is rare because it requires you to endure social discomfort. The neighbor looks richer. The index keeps floating. The commentators keep smiling. The slogans keep coming. You look cautious while they look modern for a while. Caution can feel stupid. Then gravity returns and stupidity changes uniforms. I want you to picture what a serious compression actually does to a household. It is not just a red number on a screen. It delays retirement. It changes withdrawal math. It forces asset sales that were never supposed to happen. It converts confidence into bargaining weakness. It can turn a person who felt financially independent into a seller on someone else's terms. That is why valuation is not an academic subject. It is a freedom subject. A household with little liquidity and high dependence on elevated asset values is not wealthy. It is conditional. It remains free only as long as the market remains generous. I prefer freedom that survives bad moods. That means examining the quality of the businesses you own. Yes, it also means examining the altitude at which you own them. It means questioning any environment where the crowd is paying such ambitious prices that future returns must rely on the crowd remaining even more ambitious. That is not an investment thesis. That is a chain letter, and chain letters end when gravity gets curious. Now, let me make something very clear. I am not saying capitalism has failed. I am not saying earnings do not matter. I am not saying productive assets should be abandoned. I am saying that when valuations are stretched, flows are vulnerable, and demographics are less supportive, you should stop behaving like a tourist and start behaving like a capital allocator. A capital allocator thinks in scenarios: what if multiples only mean revert partway? What if they revert all the way? What if a recession weakens the labor market enough to damage inflows? What if technology displaces enough workers to reduce automatic contributions? What if retirees keep drawing while younger contributors arrive more slowly? What if all of that happens while investors are still priced for comfort? This is not paranoia. This is adult math. The public likes certainty because certainty sells. But real investing is not about certainty. It is about asymmetry. When upside depends on continued enthusiasm while downside can be powered by both gravity and flow reversal, that is an asymmetry worth respecting. This is why I do not want you hypnotized by recent performance. Recent performance is often the voice of the crowd talking to itself. I want you looking at valuation, liquidity, dependence, and time horizon. Those are the 4 questions that matter when gravity is being mocked. What do you own? What did you pay? What can force you to sell? How much time do you truly have if real returns go nowhere? Most people hate the 3rd question the most. They do not want to admit that they are leveraged. Emotionally, even if they are not leveraged on margin, they do not want to admit that retirement dates, family obligations, health issues, or simple fear can force selling. But if you can be forced to sell, you are not just an owner. You are a future liquidity event waiting to happen. The market exploits future liquidity events mercilessly. That is why the safest looking crowd behavior can be the most dangerous. Everyone buys the broad index. Everyone repeats the same doctrine. Everyone trusts that buying every month guarantees safety. Everyone plans life around numbers that were flattered by multiple expansion and massive passive flows. Then a reversal begins, and the same uniformity that once created lift starts creating weakness. Uniform behavior can produce uniform vulnerability. Once you understand that, your posture changes. You stop asking, "What is everyone else doing?" and start asking, "What structure would leave me strongest if gravity does exactly what gravity has always done?" That answer is rarely glamorous. It usually includes more liquidity than fashion recommends. It usually includes less leverage than ego wants. It usually includes more skepticism toward price than television permits. It usually includes owning businesses you can actually understand, rather than owning a story because everyone else is applauding it. And it always includes enough dry powder that you can think clearly when other people cannot. That last point is where fortunes are really separated. In boom times, the fully invested man looks smarter. In busts, the liquid man becomes dangerous. When gravity pulls prices down far enough, cash stops being a drag and starts becoming ammunition. Everyone who mocked prudence suddenly wants a buyer. The trouble is, the buyer is the person who respected gravity before the fall, not after it. I have never wanted to be the man begging for generosity from the market. I want to be the man able to offer terms when other people have none. That requires patience. It requires a tolerance for underperforming during levitation. It requires emotional insulation from the social pressure to always participate. It requires understanding that missing a piece of irrational upside is often cheaper than being fully present for rational downside. Many people will not do this because they are addicted to motion. They would rather feel involved than be prepared. They would rather own the crowd's comfort than build their own optionality. They would rather believe that the line must keep rising because too many institutions depend on it. That is exactly the sort of reasoning gravity enjoys humiliating. Gravity does not negotiate with retirement brochures. Gravity does not care how many advisors repeat the same slogan. Gravity does not care how many workers were told to buy at any price. Gravity does not care that you meant well. It cares about altitude, support, and the moment support weakens. So what should you do? First, stop confusing broad ownership with automatic safety. Diversification can reduce single company risk. It does not abolish valuation risk. Second, examine your life for forced selling points. If a sharp drawdown would corner you into acting at the worst possible moment, you do not need more optimism. You need more liquidity. Third, understand where your return is really coming from. If you are depending on more multiple expansion from an already elevated market, admit that honestly. That is not the same as being paid by underlying business performance. Fourth, respect cash and short-duration government paper when the reward for waiting is reasonable and the reward for chasing is thin. Dry powder is not a personality defect. Fifth, prepare your mind in advance, because when gravity finally arrives, the greatest advantage is not the spreadsheet. It is emotional stability. The person who already accepted that drawdowns are possible can think. The person who built his whole identity around ever-rising prices cannot. That emotional difference often becomes a financial difference. I have seen cycles create this lesson over and over. The crowd celebrates altitude. The disciplined investor studies gravity. The crowd celebrates automatic buying. The disciplined investor studies what happens when automatic buying slows. The crowd calls caution old-fashioned. The disciplined investor calls caution useful. Then the cycle turns and language changes very quickly. I am not asking you to become a pessimist. I am asking you to stop being naive. There is a world of difference between believing in America and overpaying for America. There is a world of difference between owning productive assets and pretending price does not matter. There is a world of difference between patient investing and passive surrender. If you can learn that distinction before the next major compression, you will already be ahead of most people. And if you cannot, gravity will teach it to you in a much more expensive way. In the end, the real choice is not between optimism and fear. It is between discipline and dependence. You can keep reciting that time and the market solves everything. Keep feeding money into a structure you have never bothered to understand. Keep trusting that valuation is for academics and liquidity is for cowards. And hope gravity stays polite, or you can accept that markets like all things that float too high. Eventually answer to arithmetic, build cash, guard your optionality, refuse foolish prices, and wait with enough patience that when gravity finally clears the air, you are the one with the freedom to act. That is the test. Not whether you can sound confident in a bull market, whether you can respect gravity before everyone else feels it.